On August 1, 2012, in the span of 45 minutes, a single American financial firm lost $440 million, not to a market crash, not to fraud, but to a single line of code that should have been deleted years earlier. This is the story of Knight Capital Group, a firm so powerful it handled nearly 17% of all trading volume on the New York Stock Exchange, and how it died in less time than it takes to watch a feature film. To understand the catastrophe, you have to understand the world Knight Capital ruled. By 2012, Wall Street had become a battlefield of microseconds. The era of shouting brokers had ended. The era of algorithms had begun. Knight Capital was a market maker. Their job was deceptively simple. Stand between buyers and sellers, provide liquidity, take a tiny fraction of a cent on every trade, multiply that by billions of trades. The result was a financial empire built on speed and volume. Headquartered in Jersey City, New Jersey, the company employed over 1,400 people. It was a Wall Street institution. And, like every modern trading firm, its lifeblood was software. To compete in this new arena, Knight Capital had built an arsenal of trading algorithms. One of the oldest was called PowerPeg. Created in 2003, it was designed to test trading systems by buying high and selling low in a controlled loop, ensuring the infrastructure could handle the volume. PowerPeg had a built-in safety, a counter that would stop the trades after a specific quantity was filled. It was a tool meant only for testing. By 2005, it was retired, disabled, forgotten, but never deleted from the production servers. For 7 years, the code sat dormant, a digital ghost waiting in the machine. Nobody thought about it, nobody documented it, until July of 2012, when Knight Capital prepared to launch a new trading program connected to the New York Stock Exchange's retail liquidity program. The new system was called SMARS. Knight's engineers needed to deploy updated code across 8 servers. The deployment was scheduled across multiple days. The clock was ticking. The launch date was August 1st. A technician manually copied the new code to each of the production servers, one by one. 7 servers received the update successfully, but on the 8th server, something went wrong. The new code was not copied, and the old code, the dormant PowerPeg routine from 2003, was about to wake up. August 1st, 2012, 9:30 in the morning, Eastern Standard Time. The opening bell rings at the New York Stock Exchange. Markets come alive, and inside Knight Capital systems, something monstrous awakens. The new code reused an internal flag that had once activated PowerPeg. On 7 servers, that flag now triggered the new safe routine. But on the 8th server, the flag triggered the ghost. The old PowerPeg algorithm sprang to life, and critically, its safety counter, the one that was supposed to stop it, had been moved years earlier to a different part of the system. It would never trigger. Within seconds, Knight Capital's servers began flooding the market with orders. Not dozens, not hundreds, millions. The algorithm was buying high and selling low across 154 different stocks, exactly as it had been designed to do in a test environment 8 years before. By 9:34 a.m., just 4 minutes after the opening bell, traders across Wall Street noticed something deeply strange. Stocks were moving violently. Volume was exploding. Prices of household names were swinging by 20, 30, even 100%. The stock of Wizard Software jumped over 300% in minutes. Electronics retailer Radio Shack surged inexplicably. Across the market, chaos rippled outward. Other traders saw the anomalies and began trading against them. Knight Capital was bleeding money to its own competitors at a rate of $10 million every 60 seconds. Inside Knight Capital's Jersey City headquarters, panic erupted. Engineers stared at their screens in disbelief. Alarms had been firing since before the market opened. Risk emails warning of system errors had been sent to senior staff at 8 a.m. They had been ignored. The engineers faced an impossible problem. Stopping the algorithm was easy. But what about the millions of trades it had already executed? Each one was a real transaction, real shares, real obligations to deliver, real money already gone. Worse, the engineers initially made the situation worse. In their panic, they tried to fix the problem by rolling back the new code on the 7 servers that were working correctly. This reactivated the ghost algorithm across all 8 servers. The bleeding accelerated. At 9:45 a.m., 45 minutes after the opening bell, the system was finally shut down manually. The damage was done. Knight Capital now held a position of approximately $7 billion in unwanted stock it had bought at the wrong price, stock it would have to unload at a massive loss. The realization set in slowly. Then, all at once, the firm had lost approximately $440 million before lunch. That was more than 4 times the company's annual profit, more than the company had in capital reserves. Knight Capital, in the span of a coffee break, was insolvent. As word spread through Wall Street, Knight Capital's own stock began to collapse. By the end of the day, shares had fallen over 30%. By the end of the week, the company had lost 75% of its market value. The vultures were already circling. Knight Capital had 48 hours to find a rescuer or face bankruptcy. The Securities and Exchange Commission threatened to halt trading. Clients fled. Counterparties demanded collateral. In a desperate scramble over the weekend, a consortium of investors led by Jefferies Group injected $400 million in emergency capital. The rescue saved Knight Capital from immediate collapse, but the cost was existential. The investors took control of 70% of the company. The original shareholders were nearly wiped out. Within months, Knight would be acquired by rival Getco and rebranded as KCG Holdings. The Knight Capital name, once feared on Wall Street, ceased to exist. The Securities and Exchange Commission launched an investigation. Their findings, released in 2013, were damning. Knight Capital was fined $12 million for violating market access rules. The agency found that the firm had no written procedures for code deployment, no automated checks to ensure all servers received updates, no effective controls to stop runaway algorithms. Most damning of all, the SEC revealed that during those critical 45 minutes, Knight Capital's own systems had sent 97 automated email alerts warning of the problem. They were addressed to senior personnel. None of them triggered an automated shutdown. None of them were acted upon in time. The Knight Capital disaster became a foundational case study in modern finance. Business schools dissected it. Software engineers cited it. Regulators rewrote rules because of it. It revealed an uncomfortable truth about modern markets. The systems had become so fast and so complex that humans could no longer truly control them. The root cause was not just a coding error. It was a cultural failure. A failure to maintain rigorous deployment procedures. A failure to remove dead code. A failure to listen to warning systems. A failure to imagine that something so catastrophic could happen so quickly. In the years since, regulators have implemented circuit breakers, kill switches, and pre-trade risk checks. Firms have invested billions in automated controls and code review systems. The phrase Knight Capital event has entered the lexicon of finance, a shorthand for technological catastrophe. And yet, the fundamental risk remains. Markets today are faster, more complex, and more automated than they were in 2012. The Knight Capital disaster was not the last time an algorithm would go rogue. It was simply the moment the world realized it could happen, and that when it did, the destruction would unfold in minutes, not days. $440 million, 45 minutes, one line of forgotten code. Knight Capital's collapse was not a story about greed. It was a story about complexity outpacing comprehension, about a world where wealth and its destruction now move at the speed of light. And the only question that remains is not whether it will happen again, but when.